Let's put the spotlight on all the news that is coming out of the globe and connect with Adrian Mowat, EM equity strategist. Adrian, thank you so much for taking time out. Lots to discuss when it comes to the overall global front. I just wanted to understand first up how you believe investors should be digesting the US inflation, which has risen quite moderately in the month of July.
Yeah, I suppose this question really relates to what is the Fed going to do in the September meeting. And so the ongoing moderation in inflation continues, which is good news. We have to remember that it is above the 2% target. We had what was perceived to be a weak employment print, which has got a lot of discussion going about a 50 basis point cut in the September meeting. I think that it's very balanced between the Fed moving 25 basis points versus 50 basis points. And we do have some more labor market data coming out. And so the market will probably be very sensitive to that. But let's understand where we are here. We are now with the Fed moving policy rates slowly back to neutral. It arguably gives you a dollar that begins to weaken. And for emerging markets to have a combination of an end of strong dollar and the Fed beginning to move to a more neutral policy takes away some significant headwinds, perhaps even gives you some tailwinds.
Adrian, I'm more concerned about also the data coming out of China because that sort of has a linkage to India flows as well. The manufacturing has slumped to a 6-month low. I mean, is China clearly not out of the woods yet?
So, we've got a structural problem in China. There are significant issues in the real estate market, both commercial and residential. Property sales were down dramatically year over year again. There are some meaningful deflationary forces at work as asset prices fall, and the impact of having leverage hits the ability of corporations and individuals to consume. And I think that's just your investment backdrop. We're not going to escape that structural issue. Now, you could become very bearish sort of talking about that, but it's very important to remember that Japan, which was the second largest economy for a long period of time, went through 2 decades of deflation within Asia. That did not stop the rise of China. It did not stop the rise of India. So I'm not too worried about the external impact of what's going on in China. I would also note in terms of the manufacturing numbers, the official manufacturing number, which is more heavily influenced by heavy industry, was very poor. The Caxton PMI, which was just come out today, was better than expected. And that might reflect the fact that exports out of China have been relatively strong. So don't read too much into what's going on in the Chinese economy in terms of your willingness to buy a market like India. I don't think it is a significant impact on the Indian economy, or even to some extent the regional economies, with one major exception, which would be Australia, where we have seen a significant decline in commodity prices, which obviously hits the Australian current account.
Adrian, so what's next? If I say what's next for the markets now, could it be US election? Could it be Fed? What's next for the markets from here?
So I think the markets will be very focused on the US economic data. If you think about what are the various paths that we could take from here, it might be that the employment data comes out and it proves to be a bit more robust than the market expects. And then some of the rate cut expectations will be moderated. I suppose it's worthwhile maybe just sort of talking about what I'm thinking about as a base case. I think US rates could easily move from 5.5 down to maybe 4.5, with perhaps a neutral rate of around 3.5 hit some point in the middle of next year. I think that would be a sort of very bullish scenario. If the employment data is stronger than expected, then you're not going to get a 50 basis point rate cut. And we're probably not going to move below 5% this year on Fed funds rate. Now, you can take the other extreme, which is actually the US employment numbers are really losing momentum, and the Fed is deemed to be behind the curve and needs to cut rates more aggressively to get to neutral or even below neutral. And perhaps you get 300 basis points of cuts over the next 12 months. I think that's a negative message for the US equity market in terms of people be concerned about profits. It'll be a negative message for countries like Mexico that sell a lot to the United States. But it may be okay for other emerging markets in that they get the very important tailwind of a significant reduction in interest rates. And I think it comes back to this idea that after a significant period of underperformance for broad emerging markets, obviously India is not part of that story. It's been a great performer. I think you have the chance that emerging markets actually begin to outperform developed markets because of this new environment, which is the end of strong dollar and the Fed cutting rates.
So good having you on the show and sharing quick morning thoughts. Thanks for your time.
Thank you. Bye.